Welcome to LR Reports. This channel focuses on institutional research that I've personally reviewed. As a fund manager and family office analyst, my role is to filter through a large volume of research and focus only on what truly matters. AI helps structure and deliver the content efficiently, but the selection and interpretation are human.
Okay, so today we're digging into a pretty fresh note. It's from Goldman Sachs Global Investment Research.
On the U.S. solar sector, right?
Exactly. Published January 19th, 2026. This is their big America's Clean Technology Outlook for the year. And, it feels like they are taking a major swing against the consensus here.
It really does. I mean, it's a dense piece of research. Usually when we look at solar, everyone is just obsessed with interest rates.
If rates go down, solar goes up. That's the whole story.
But Goldman is basically saying stop looking at the Fed. They're arguing the story has shifted. It's all about earnings execution now, and these really specific policy details.
And they're making some pretty contrarian calls, especially on Enphase.
Oh yeah, the data center trade too.
So, the real headline grabber here, it has to be Enphase Energy, right? Ticker ENPH.
For sure. They upgraded it from neutral to buy, and they jacked the price target up to $45.
Which is happening right as short interest is hitting historic highs. The sentiment is just incredibly bearish.
It's a bold call, a really bold call, because the consensus view is that Q1 2026 is, it's going to be a disaster.
A revenue trough is what everyone's expecting.
Right. You've got your standard winter seasonality. Solar always slows down in Q1. But on top of that, you have the expiration of the 25D tax credits.
That's the big residential credit that just rolled off.
Exactly. And usually, when a subsidy dies, demand just falls off a cliff. So the street is bracing for impact, kind of staying on the sidelines.
But Goldman thinks the street is missing a specific regulatory quirk here. They're actually predicting a beat and raise.
Not because of organic demand, though. Not because homeowners are suddenly buying panels in February.
No, it's because of this idea of safe harboring.
We really need to unpack that term. It's the absolute linchpin of their bull case for Enphase.
So, safe harboring is basically a tax loophole. It lets developers lock in the current, more favorable tax credits, the 48E credits, before the rules change in July 2026.
And to qualify, they have to do one of two things. Either physically start construction or
spend at least 5% of the project costs now.
And Goldman found what looks like a smoking gun.
A closed $55 million deal with a TPO, a third-party owner.
Right. So this is a big leasing company buying a ton of equipment early in Q1 just to let it sit in a warehouse. They're doing it just so they can claim that tax credit later in the year.
It's an artificial demand spike.
Completely. If you're Enphase, you're shipping product in Q1 that isn't going on a roof in Q1. It's just satisfying a tax requirement.
The risk seems pretty obvious then. Is this actually high-quality revenue?
That's the question. Goldman argues it doesn't matter, at least in the short term. It drives a beat against incredibly low expectations. But if I'm an investor, I'm asking, are we just borrowing demand from Q3, from Q4?
A pull forward.
Exactly. If it's just a pull forward, maybe the stock pops on the earnings print, but then it just bleeds out when the guidance for the second half looks weak.
It seems like Goldman anticipates that pushback, though. Their counter is that the market is so heavily short that even what you might call a low-quality beat is enough to squeeze the bears.
They call it the short interest paradox, and the numbers are pretty stark. The solar sector has beaten the Russell 2000 by about 400 basis points recently.
And yet, days to cover short interest is up 30% in just the last month.
It's a classic powder keg. The market is betting on a collapse. But if Goldman's right, and fundamentals are actually stabilizing, and then you get this tax-driven revenue bump,
the shorts are trapped. They have to cover into a rising tape. It becomes a technical setup, not just a fundamental one.
Right. But, underneath all that technical noise, there's a much bigger, more structural question that Goldman is trying to answer.
Which is?
Can the utility scale side of the business, these giant solar farms, can they actually save the whole sector from the residential slump?
That is the core friction in this whole piece. The divergence in their model is just massive. You've got utility-scale revenue projected to grow, 20% year over year?
Something like that, yeah. The policy noise is fading, and now it's just about bookings visibility, getting projects built.
But on the other side,
residential solar. facing a double-digit decline in 2026 because the investment tax credit stepped down.
And Goldman seems to think that residential collapse is already priced in, that the bad news is known.
So the trade becomes identifying the survivors, the ones who can consolidate market share. They point to Sunrun and, of course, Enphase.
You know, I'm a little skeptical of that already priced-in narrative. I mean, this residential air pocket is a very real threat.
So you think the decline could be worse than expected?
It could be. Goldman is banking on something called prepaid leases growing to 10% of the market. Right now, that number is basically zero. And those are for customers who want to bypass high interest rates by paying up front.
Right. But that's a huge assumption. If consumer demand drops faster than those prepaid leases can ramp up, the whole recovery story for ENPH and Run, it just breaks. You can't consolidate your way out of a market that shrinks by 30% instead of 10%.
Okay, so let's shift to where that utility scale growth is supposed to come from. This is where the whole AI narrative really comes into play.
Yeah. The report argues that the power demand from hyperscalers, big tech building data centers, is finally actually hitting the order books.
And this is where the research gets really concrete, which I like. So often data center demand is just this fuzzy buzzword.
Exactly. But they point specifically to Fluence, ticker FLNC. They have a pipeline of over 30 gigawatt hours of data center projects.
And here's the kicker.
80% of that originated just since September of 2025.
Wow. So it's immediate. It's not a 2030 story. It's a Q1 2026 story. The hyperscalers are finally cutting checks.
It validates the thesis for companies like Fluence, like Array Technologies. If you're selling batteries or trackers to these massive projects, you're directly leveraged to this AI build-out.
But all that demand doesn't really matter for U.S. manufacturers if they just get undercut by cheap imports. Which brings us to the second pillar of the thesis.
Protectionism.
Right. Goldman believes pricing power is coming back to U.S. companies like First Solar because the walls around the U.S. market are just getting higher.
And they're getting higher from both sides, which is interesting. You have the U.S. enforcing Section 232 tariffs and the FEOC rules, the Foreign Entity of Concern rules.
Which basically bans battery materials from China.
But then China itself is also cutting its own production. They're calling it anti-irrational price competition. They want to stop prices from crashing.
So global polysilicon prices jumped 20% in Q4 because China turned off the spigot.
Which creates a price floor. It helps margins for everyone, but especially for the protected U.S. players.
In theory.
In theory. The moat is only as deep as the government's willingness to enforce it. When the entire buy thesis on First Solar and the sell thesis on Canadian solar, it depends completely on the U.S. Treasury being ruthless with those FEOC rules.
And we're still waiting on the final guidance for that.
We are. If there's a loophole, if a Chinese company can just route panels through Vietnam and get around the tariff, First Solar loses that pricing power overnight.
And the options market seems to be terrified of that exact scenario.
Yeah, the skew is telling a very different story from the analysts' rating.
Even with Goldman's buy rating and a $316 price target on First Solar.
The skew is just a fear index, basically. And when it's high, it means puts are way more expensive than calls. People are paying a massive premium for downside protection on FSLR.
So they believe the earnings story, but they're hedging against a political rug pull.
It's a fascinating disconnect. The analyst says buy for fundamentals, but the market is screaming hedge for politics.
So let's talk about that First Solar valuation. A 12x PE on future earnings plus net cash. Is $316 actually realistic if that policy wall holds?
Historically, yeah. 12x is reasonable for a manufacturer with that kind of protected position. But the valuation is incredibly precarious.
Because the ENPE is inflated by the tariffs.
Entirely. If the tariffs go away, the earnings collapse. So you're not just betting on First Solar's execution. You are betting on the outcome of the Section 232 review in March 2026. It's a binary event.
And on the flip side of that coin, they are screaming sell on Jinko Solar and Canadian Solar. They're basically calling them uninvestable.
And for good reason. It's not just about losing market share. It's about a massive liability hanging over them.
Retroactive tariffs.
Right. Canadian Solar could owe anywhere from $1 to $2 billion in back payments. That's a huge hole in the balance sheet. Goldman's point is pretty simple.
Why would you own a stock that's technically cheap but has an unquantifiable billion-dollar fine hanging over it?
It's a classic value trap.
The purest sense of the term.
Okay, what about Array Technologies, ticker ARRY? They say bookings need to break 500 million to prove the growth story's back.
Array is a show-me story. The data center tailwind should drive those bookings up. But you have to look at the margins. They lowered guidance to 27-28% on gross margins.
Because tariff costs are eating into profit.
Exactly. So they might have the volume, but they're making less money on every unit. So the question for investors is, can that volume growth outpace the margin compression? If bookings come in light, that stock gets punished.
And Shoals, SHLS. They're looking for a book-to-bill over 1.0.
Shoals is tricky. The product is great, but the company is just bogged down in patent litigation. It's a drag on EBITDA. It's a case where the operational story is fine, but the corporate story is just messy.
And Fluence. We mentioned the data center backlog, but there's a specific trigger to watch, right?
It's the battery cells. To get that full domestic content subsidy, which is pure margin, they need US-made cells. They have a deal with AESC to supply them. Investors have to watch for that deal being finalized. If it falls through, Fluence loses that margin kicker. It's probably the single most important milestone for them this year.
So if we look at the big picture, the one structural metric that kind of holds this entire thesis together is that utility scale pipeline number.
That is the load-bearing pillar. Additions were up 34% quarter over quarter in Q4. That's a record. It confirms that the macro headwinds are finally being overpowered by the reality of needing to put steel in the ground.
And if that number slows?
If pipeline additions drop to, say, 10% or flat, then the data center narrative is just hype, and the whole sector probably rolls over.
Okay, let's distill this. The consensus trade has been wait for the Fed. Goldman is saying that trade is dead.
Correct. The trade is shifted. You stop buying the concept stocks, and you start buying the builders.
So, step 1, long end phase for the tactical trade. Playing for that Q1 beat from safe harboring.
But with a tight stop. It's a bet on a technical squeeze. If the market decides the revenue quality is trash, that squeeze won't last. It's a rental, not a long-term hold.
Step 2, long First Solar for the strategic moat. That's a bet on pricing power.
But you have to hedge the policy risk. If you're long FSLR, you should probably be buying puts. Or just accept that you're really just making a bet on US-China trade policy.
Step 3, buy the volume growth through Array and Fluence, the direct play on data center power demand.
And watch those specific catalysts. That 500 million booking number for Array, the AESC battery deal for Fluence. If they miss, the thesis is broken.
And the do not touch list is pretty firm. Any manufacturer with deep Chinese supply chain exposure. Jinko, Canadian Solar.
It just doesn't matter how cheap the PE looks. That tariff liability makes them uninvestable for any prudent manager. You just can't model a billion-dollar fine.
So the bottom line here is that the easy money era is over. Goldman's view is that 2026 is all about the gritty details.
It is. It's a compelling thesis. It requires you to believe that policy walls will hold and data center demand is immediate. It's not a low-risk strategy, but for the first time in a while, the risk-reward seems to favor the bulls who are willing to really dig in.
That's how we approach research internally. Filter first, then analyze, and only then decide what's worth sharing. If you find this useful, feel free to follow the channel. I'll see you in the next episode.